We all know how to invest in real estate properties. In fact, we may have spent a lot of time doing a lot of research before we bought our first property. But let us assume for a moment that you had made your property investment about 20 years ago. And today, for some reason, you're looking at disinvesting it. Do you want to know how the process goes? What are the options available for you to invest? That's what we're going to check out in this video. But before we go there, what are the reasons why someone may want to divest their property investments? First, you may have invested 20 years ago thinking that it's a good investment option which will give you great returns. And maybe you got that great returns as well. And off late, the returns are starting to flatten out. So not a bad idea to encash the investment currently. Second, you could have invested it for a specific goal, either your son's education or your daughter's wedding. And this is exactly the time that you need the money for it. It's not a bad time to encash that investment to pay for the expenses that are about to come. You may have invested with the idea that you wanted to kind of stay in the country and enjoy the property, and for some reason relating to work, you are migrating or immigrating to a foreign land. Therefore, you feel there is no point in trying to administer property sitting in a foreign land. So you may want to sell it and either take the money or reinvest the money in something else. Last, as you are getting older, it's also imperative for us to start consolidating your investments. Especially if your children are not here and they are settled abroad, it makes sense to have lesser real estate assets closer to you so that your children can enjoy them after your time. So these are all the reasons why one would look at possibilities of divesting their real estate holdings. Let's look at some of the key terminologies that are important to help you make the correct choice of investments. First up, the sale price is nothing but the price that is mentioned in the sale deed that gets registered with the sub-registrar office. Next is the net sale price. What is the difference between a sale price and net sale price? The net sale price is sale price minus any incidental expenses to sale. The incidental expenses could be brokerage that is paid to a real estate agent or any such expenses that are incurred in the course of selling that property. All these must be evidenced by a payment voucher which contains all the details including the PAN number of the person to whom the money was paid. Next is the purchase price. Purchase price is the price at which the property was originally bought. In this example, if it is 20 years ago when the individual purchased the property, what is the property price mentioned in the purchase document, which is the sale deed at that time? Then you have the concept of indexed purchase price. The income tax department provides that for every year, there is an indexation benefit that equals to the inflation rate of that year. The last index table started in 2000-2001 at 100, currently is about 345, and likely in the financial year 2024-25 to be 365 or thereabouts, which means there is a 4%, 5% index benefit on account of inflation that is given as an advantage to the person selling the property. So one needs to index the purchase price so that you bring it on par with the current value of the property. Capital gains is nothing but the net sale price minus the indexed purchase price. The difference is considered as a capital gain. Capital gain bond is a bond that one invests into under Section 54 EC of the Income Tax Act. This bond can be invested in Rural Electrification Corporation or IRFC, which is again a Government of India enterprise, or Power Finance Corporation, which is again a Government of India enterprise. All these are different corporates which accept a deposit from the investor under Section 54 EC that helps him avoid capital gain. They pay an interest rate at 5.25% per annum, which is taxable. The tenure of the bond is 5 years, so one needs to stay invested for a 5-year period. The bond can be purchased either in the physical format or in the demat format. the interest is paid without tax deduction at source, but the individual must report it in their tax return and whatever is the tax that needs to be paid for. The low volatility debt funds or hybrid funds are nothing but investments that don't invest heavily into equity markets, maybe to a lesser extent or may not be any extent at all. These provide a certain amount of stability and safety to the investor's money, but they are also low in terms of returns that they provide to the investor. The aggressive equity funds are investments that are made into equity mutual funds or equity stocks that are quite aggressive in nature. They can be very volatile on a given period of time. They can fall as much as 10-15% or they can go up by the same measure. With volatility comes also good returns. So as long as somebody stays for 5 years and beyond, they can hope to make a reasonably good return if they choose the aggressive equity mutual fund kind of an investment option. Let us take the example of a certain capital gain working. Let us assume that the sale price is 70 lakhs and the brokerage paid for the sale of this property is 2%, so 1.4 lakhs is deducted. So therefore the net sale value is 68.6 lakhs. In this case, the assumption is 20 years ago this property was purchased for 8.5 lakhs. Therefore, if it is sold in the financial year 2024-25, it is assumed that the index value will be 365 as against the index value at the purchase date, which is 2004-5, which would have been 113. So if you index 8,50,000 into 365 by 113, you get 27.45, which is the indexed purchase price as on this date. Therefore, the capital gains that arrives is 41,14,000. Now there are three investment scenarios that are available to any investor. Somebody who doesn't want to pay even a single rupee of tax in this instance can go and invest the entire amount of 41 lakhs and change into the capital gain bonds in any of the three organizations, REC, Power Finance Corporation or IRFC. The entire capital gains tax is avoided in this method. The individuals enjoys a 5.25% return per annum, which is an annual payout that comes to his bank. If one were to aggregate for 5 years this measure, the amount that one enjoys, not considering the tax, is 53.13 lakhs. So 41 lakhs becomes 53.13 lakhs. Let's look at a second scenario where out of 41 lakhs, the investor chooses to pay a certain amount of tax and reinvest the balance in the manner they so choose to. Out of 41 lakhs, 8 lakhs goes out as tax. The balance of 32 lakhs gets invested. Now, if the investor is a conservative investor who chooses a debt option or a hybrid option with low equity and high debt, he is likely to get 10% or less over the 5-year period. If one were to consider that, then the return overall he will enjoy is only 53 lakhs. The scenario, which is the third, is similar to the second one. Investor chooses to pay tax. The balance of 32 lakhs, he chooses to invest in aggressive equity or mutual funds that have the capability to generate 15% or more. If this were the option one were to choose, then the likely maturity at the end of 5 years is 66 lakhs, which is a significantly higher number. In conclusion, what scenario to choose is entirely dependent upon the temperament of the investor. Let us assume you're a conservative investor who is not going to take big risks. Then our recommendation would be for you to stick with the capital gain bond. You are getting an assured 5.25% per year, and more importantly, you're saving 20% tax outgo at the upfront. So there is a definite advantage for conservative investors to choose this option. You would end up with a reasonably predictable corpus at the end of 5 years, which you can do what you choose at the end of 5 years. But if you're somebody who is capable of taking risks, you're aggressive by nature, then you can afford to pay the 20% tax, and the balance of money could get invested in either aggressive equity or aggressive equity mutual funds, which have the potential to generate 15% or more, and thereby you will have a much bigger corpus at the end of 5 years than the conservative one. But remember, this option is not guaranteed and it is fraught with volatility and risks. But if you're somebody who's confident of making it happen, then you should go for it. Eventually, it boils down to what your temperament is. Conservative temperament, go for capital gain bond. Aggressive, stock market oriented temperament, go for stock market oriented investments.